It's been a tough week for the U.S. dollar, falling to fresh 2009 lows on concerns over the U.S. losing its AAA rating. Take a look at the one-week chart of the dollar index here. Moved down rather noticeably. As you see that's six-month low. Weak greenback is making the case for a reemergence of emerging markets. What are your best non-dollar plays? Let's ask Peter Schiff. He's the president of Euro Pacific Capital. Ron Shaw is at private equity firm Gina Ventures. Gentlemen, thanks for joining us. Peter, before I get to your picks, let me just ask you about the dollar. There was a flurry of worry this week as the Brazilian president met with Chinese officials. There was talk they're looking for ways to dump the dollar as the international currency of choice. Is that a likely possibility anywhere in the near future?
Oh, it's not only a possibility, it's inevitable. You know, you're talking today a lot about the U.S. losing its AAA rated status. I mean, it already has, as far as I'm concerned. And when you're talking about, rating sovereign debt, you're not rating default. It's nonsense to really talk about the U.S. government defaulting. The problem is we have a printing press. We can pay our debts by printing money. And that's what you're measuring when you're measuring, credit quality for a sovereign government in its own currency. And we've already told the world we're not going to pay back our debts legitimately.
So where do you want to be instead, Peter? I'm just curious. If you're going to buy a currency, where do you want to buy it?
Well, you want to get out of the dollar. I mean, look at look at the New Zealand dollar. It's up 30% in the last 2 months. Mm-hmm. That's just 2 months. I mean, if you put New Zealand dollars under a mattress,
I don't really agree with that. I think that the U.S. dollar would continue to be the denomination of choice.
Why, Ron?
And the reason for that is because management, expertise, innovation, R&D continues to be in the U.S. And my faith in the U.S. is driven by the fact that I believe that managers in the U.S. can go overseas, acquire assets, integrate them, and have a long-term future. That's really the future for the United States over the next 5 to 10 years.
But the problem with the United States is our economy is a disaster. A lot of foreign stocks sold off last year. They're quickly recovering those losses. They're still inexpensive. But the thing is, the foreign global economy is not nearly as bad as people think. But the U.S. economy is in much worse shape. And now that the dollar has lost that flight to quality bid, now that people are fleeing dollars and fleeing treasuries, this is really going to compound our problem.
Regardless of what anybody thinks about what's going to happen to the U.S. economy, clearly, Ron, the people are voting with their money. Money is clearly moving out of dollar-denominated assets, has been for several weeks, even arguably months now, and into overseas assets. So what do you do if you see that trend? If you're agnostic on the whole debate, but you're just following some of the money, what do you do?
Well, I think there's clearly been bubble-like behavior in China and India. I mean, both economies have faced event-driven rallies over the last few trading sessions. India has had the election, which is actually really great for long-term prospects for India. China also had their stimulus plan. They also announced restructuring oil refineries. So there's been a lot of rally based on events. So I think there's been capital flight. But if you look at these markets, you see bubble-like behavior. Even the billionaire in China, Li Ka-shing, mentioned that China is in a bubble. I mean, with a name like Ka-shing, how can he be wrong?
Yeah. I mean, I disagree.
Peter, what do you like overseas? What are you buying right now? How do you play this?
I disagree. There's a bubble. We're buying a lot of Chinese names, a lot of them through Singapore and Hong Kong. Most of the stocks that we're buying are still trading at single-digit PEs. 4, 5, 6 times earnings.
Like what?
Many of them, well, I mean, no one's going to know the names here. They're trading in Singapore and Hong Kong. They don't have ADRs. But, they're companies that have dividend yields, in many cases, north of 10%.
So what are you recommending then for investors? I mean, I just want some actionable advice here. I mean, would you say that
the actionable advice is to sell U.S. stocks, sell U.S. bonds, and sell the dollar and protect your wealth by going abroad, by buying,
Of course, Peter, that's all
companies.
You do, right? That's your firm, Euro Pacific.
Well, that's what
that's your mandate.
Well, no, it's not my mandate. I own the firm. The firm does what I believe. And I believe the U.S. economy is in trouble. I believe the dollar's in trouble. I believe Americans are going to lose a lot of wealth if they go down with this ship. So what I'm trying to do is help people protect their wealth by getting it abroad, by getting it out of dollars, by protecting them from Ben Bernanke and from President Obama and what this Congress is doing to this country.
So, Ron, you're here in the you're not as invested overseas. You're here in the United States. At least you're in commodity stocks, though, correct?
Well, I'll tell you, I think the play for Americans is two things. What we do is we do invest overseas, but our model has changed significantly. We continue to believe that the U.S. market and the European market continues to have the management expertise that's needed to drive emerging market growth. So the play for Americans, I think, are two things. I think you should invest in American companies that have demonstrated a track record of being able to go overseas, expand, and integrate assets, because those countries, India, China, they need American management expertise.
So that's how you play the international aspect
Absolutely.
of it.
So, for example, Pfizer. Pfizer announced 2 big deals in India over the last week. They did a deal with Aurobindo and Claris, and basically they're taking advantage of the Indian market, and they're going to pave the way for a lot of other pharma companies.
Peter, the decoupling idea kind of went out the wayside, did it not? I mean, if the U.S. is going to fall apart, as you seem to think, in the next 6 months.
Decoupling again.
Well,
yes.
listen, he's saying, throw everything overseas and forget about the United States.
Yes.
Decoupling didn't work.
No, it did. Look,
right.
a lot of people, were bought into that head fake in late 2008. Believe me, decoupling is real. It's happening. And the thing is, we're not the engine, we're the caboose. And when we get decoupled, the world is going to thrive. I mean, initially, they had some financial losses. The world loaned us trillions of dollars, and we can't pay it back.
So you're still buying that, Peter, huh?
Well,
you
I'm
still
not
buy
buying
that
it.
theory?
Look,
the
the world doesn't need our
consistent.
consumption. The world doesn't need our consumption. We need their production. The global economy is fine without propping up the U.S. economy. We are in serious, serious trouble.
I think we got to give last word to Ron here.
It's always the same tune with Peter.
Look, why don't you go back and look at the things I said a few years ago and see how that tune is playing out?
Ron?
I think there has been a little bit of a sign of decoupling, but I don't think that we are going to have decoupling here to stay. I think that for, at least in the medium term, these foreign countries, India and China, depend on U.S. demand. At least China clearly depends on U.S. demand.
They do not. We depend on them.
Right.
We need their production. We need their savings.
There is a codependence there. But
no,
China,
it's not codependence.
All right, guys, we're going to have to leave it there.
Wrong.
It's a fantastic debate. We'll continue it
Thank you.
in the months ahead.